Identifying key levels for trading breakouts begins with reading the chart as a record of crowd behavior. Price does not move randomly for long. It pauses, tests, hesitates, and returns to places where buyers and sellers have previously fought for control. Those places are often the levels that matter most. The first level to watch is recent support and resistance. Support is the area where price repeatedly stopped falling before moving higher. Resistance is where price repeatedly stopped rising before turning lower. The strongest levels usually come from multiple touches on the same zone, not from a single isolated candle. A breakout has more meaning when price has spent time building pressure against a clearly visible barrier. Next, look for swing highs and swing lows. These are the turning points that define the structure of the market. A breakout above a prior swing high suggests buyers have overcome a recent obstacle. A breakdown below a prior swing low suggests sellers have gained control. These reference points help separate minor noise from a meaningful shift in direction. Volume can confirm whether a level is important. If price approaches a level with rising volume, the market is showing interest. If a breakout occurs with strong volume, it may indicate real participation rather than a temporary spike. Weak volume can imply that the move lacks commitment and may fail. Trend context also matters. In an uptrend, prior resistance can become support after a breakout. In a downtrend, prior support can become resistance after a breakdown. This change in behavior is often called a retest or role reversal, and it is one of the clearest clues that a level has real significance. Psychological price levels often attract attention as well. Round numbers such as 50, 100, or 1,000 can become crowded decision points because many traders place orders there. These levels are not magical, but they often align with practical market behavior and can contribute to breakout setup quality. Time frame alignment improves accuracy. A level visible on a daily chart usually carries more weight than one seen only on a short intraday chart. However, traders often use a higher time frame to define the major level and a lower time frame to refine the entry. This helps avoid chasing false breakouts inside broader market noise. False breakouts are common, so confirmation is important. A brief move above resistance does not always mean the level has been broken. Traders often wait for a candle close beyond the level, a retest that holds, or continued momentum after the initial move.